Per usual, everything on this channel is for educational purposes only. It is not intended as financial advice. It is Monday. That means it's Macro Monday, July 4th week. Happy July 4th. I'll just mention again quickly the Twitter list I put together for macro data. This is where I get all the information on the macro side of things. I know Twitter's a mess right now, but if you want to follow this list, I'll leave it in the description of the video below. So macro, again, is everything around us, honestly. It's mortgages, it's grocery bills, it's car loans, it's wages, and obviously inflation has been running extremely hot post-COVID. The monthly main events have always been, the Fed meetings and the CPI prints. The last CPI print was 4%. This is a year-over-year print. Previously, it was year over previous 2 years. They adjusted that at the beginning of this year. So even though the year-over-year number in real time, based on Truflation's estimate, continues to get smoked, it's almost at 2%, right? This has different methodology than government CPI. Government CPI uses lagging housing data, uses different housing data, and then, of course, you can slice and dice the CPI components into whatever basket you want, right? We can take out housing, we can take out food, we can take out, we can call it whatever we want, super duper core, and justify basically anything. Some people love Truflation, some people hate it. It is, I think, one of the best real-time estimates we have. So that's why I talk about it a lot, and it continues to get crushed. So between the election in 24 and CPI potentially, steadily approaching 3 or less, I think Powell will have less maneuverability on continuing to raise rates. I think holding rates will be more palatable than continuing to raise when CPI is what it is. Even though PCE is still elevated, core is still elevated, the political pressure, I think, on him, especially if more small banks start to fail, if he continues to raise rates, might be an issue. Now, you might go out to a restaurant on any given weekday and it's full, weekend especially, Taylor Swift tickets selling aftermarket for thousands of dollars above market price. The list goes on and on and on, right? There are plenty of anecdotal data points to support things are still going strong in the economy. And, I see a different version of this graph basically every week touting excess savings as if it's a bad thing. But, this is pointing to maybe more of the demand side where everybody was in their house. They couldn't spend anything on anything. And then, travel right now is also insane. Revenge vacations, whatever you want to call it. But this continues to dwindle. The post-stimmy high is definitely ending here shortly. And especially with student loan payments being back on the table here in the next couple months, that's going to continue to chip away at stuff like this. Now, the UK is kind of a different story. The UK is, based on metrics that I'm looking at, in quite of a kerfuffle here with their, savings basically just depleted completely. And if we look at Truflation's estimate of UK, it's still at 11%. So they have a ways to go on that side of the pond as far as what they need to be doing in their central bank. And you could say, well, again, I don't trust Truflation. This is way out of control. It was at 20% at the top, right? It's a data point, okay? There are good data points, there are bad data points. There are data points you need to understand what the components are, but anyway, it's here, you can look at it, check it out. So as bearish as people are on the United States, perhaps, there's just doomers as far as the eye can see. Things are much worse elsewhere, much worse. This is a graph from Ecoinometrics, another just amazing, this is who I want to be when I grow up as far as the charts that this guy creates. Just phenomenal stuff. And this is looking at core inflation and wage growth. This is a part of that, health of the consumer, the jobs market, more macro stuff. Are wages keeping up with inflation? Are wages spiraling out of control where, businesses have to raise prices, wages then come up, and then it's just this wage price spiral, as they call it. And that certainly happened in many larger cities in the United States. But anyway, core is still higher than interest rates. So again, if Powell wants to use this as justification, he certainly can, to say, well, we need to keep going, or we need to keep our foot on the pedal as far as rates where they're at. If we look at rate probabilities for the next meeting, the end of this month, they are distinctly in a hike. If not a hike this month, a hike eventually, but definitely holding rates for a very, very long time at 5.25, 5.5, whatever that is. That's going to continue to strain smaller banks. There's going to continue to be flows out of bank deposits into better yield generating devices, money market funds, and the like. And you're probably going to see more headlines about banks being in trouble, smaller banks being in trouble. The big banks are totally fine. They don't want your money. It's a liability. The smaller banks aren't really profitable anymore. So the next CPI prints on July 12th, and that means the Fed will have plenty of time to digest that. The markets will have plenty of time to digest that and ponder what the Fed will do. But again, if CPI is getting crushed, I think the Fed's going to have a harder time raising. On the flip side, if S&P and NASDAQ are roofing, they're probably going to be fine with raising. And the next unemployment print is at the end of the week. So if unemployment's up, that may also tip the Fed's hand into holding rates where there are. But my guess is unemployment's going to be muted at best, and things will be fine. On the Treasury General account side of things, there was a worry that the coffers needed to be refilled and that money was going to come from risk assets purchasing Treasury bonds that were being issued to refill the TGA. Thus far, that hasn't really been the case. Thus far, that money has come from reverse repo. I'll show that in a second. I believe the target for the TGA is somewhere around $500 billion. That's where they want to get to. So they're almost there. They have a little ways to go, but they're almost there. And, this is, of course, the concern of everyone. The background concern is runaway debt. When is this going to matter? This won't matter until it does. Some people are saying, Balaji, for example. And many rational people are saying this is just untenable, can't keep going on forever. And this is why Bitcoin wins in the end. Hard assets win in the end. It certainly doesn't look great. I'm just here to look at the data, not necessarily give you an opinion on that specific data point, but it doesn't look great. This is reverse repo, basically overnight lending agreements. And this is where the TGA refill has mainly come from. It has not come out of risk assets. So it's come out of money that's basically already inert out of the system. This wasn't in NVIDIA or Microsoft or Apple, right? This was just parked on the sidelines already. It is up a little bit recently, but we're not seeing a flight out of risk. I'll put this reverse repo explanation in the description for those looking for more. Onto the S&P, as many people have said, if you're following markets at all, right, bad breath as far as the top performers, the Magnificent Seven or Elite Eight, whatever you want to call them, are feeling all of the gains. It's tech, it's AI, whatever you want to call it, right? Tesla, I don't know. And we continue to see that some of that breadth is evening out. We're probably seeing some rotation out of the Elite Eight based on this representation from Bianco, but it's still quite something relative to the rest of the market. And also interesting was this chart, I forget, maybe it was from Goldman, but the year-to-date performance of meme stonks, let's call them, outperforming basically everything, and that begs the question, is that healthy? Down the worst, up the most. Makes sense, but is that a world we want to live in? Doesn't matter. I don't know, just another data point. I want to talk about the yield curve real quick. We continue to steepen on the yield curve inversion. Orange here is unemployment. And the argument isn't that the inversion itself is bearish or calls for an imminent recession, but the uninversion is where you get the employment rises in unemployment and the recession. So the question is obviously how much longer can this go on? Forever? Typically you get paid more for your duration as far as banks sticking that in bonds or whatever, right? That is not the case here. That's what that means when the yield curve is inverted. So still very much an issue. NASDAQ best total return on record dating back since 1999, again from Bianco, just amazing charts. And more of that down the worst, up the most mentality, right? Look at most of crypto. Just down extremely bad in 2022, Bitcoin plus 80% this year, right? Year to date. So even the NASDAQ's having an unusually good year to date return here. As far as some individual stuff, before we get to the charts, there was a tweet about MSTR's market cap being smaller than its Bitcoin holdings, which was really interesting. A couple days ago, it's up, I don't know, 8% today, but yeah, 9%. You know, there may be something there where that's pretty relevant to the price of MSTR if it starts to dip below its treasury holdings. So you can always compare that market cap value to the Sailor tracker, 4.72 billion now. He is break even, just above break even, we'll call it, as far as his DCA value. So he is in profit here, definitely. And finally is buying at reasonable levels and not 60,000. But over time, that level may not even matter. So MSTR is up a bunch on this. Coin is up a bunch today. One last thing I'll just mention, the SPR. There's nothing more political than the SPR. If Trump was draining it, I wonder if it would be as big of a deal as it seems to be that, Biden is draining it or Granholm is draining it or whatever, right? Secretary of Energy, I think, right? Granholm, she has said that they are going to be buying in the high 70s, I thought. We were there for a minute. There was some oil news today. Energy prices, again, relevant to all of us, gas, heating, whatever, electricity, worth paying attention to. But this is basically the emergency reserve. If crap hits the fan, this is where the U.S. dips into to shore up the market. When there was Hurricane Katrina or there's oil issues anywhere globally. So the argument is we need this as an insurance for random events. You'd rather have it and not need it than need it and not have it. I get that entirely. I'm on board. But to me, there's plenty of oil there. OPEC is cutting because there's plenty of oil. We don't have no oil that isn't available. We have too much oil. So I'm not really worried about the SPR in the near term. For sure. It's just funny how political it's become. All right, let's talk about some charts. S&P continues to look like it's setting up for a bear div. It is very likely ready to reach for that multi-month inverted head and shoulders range target. This thing looks, to many people, divorced from fundamentals entirely. People arguing if we're just issuing debt, it doesn't matter. PE ratios are going to keep rising. I don't know. Okay. I'm just looking at a chart and it looks like we're setting up for a bear div. So my main worry here is that even though crypto is decoupled from TradFi, that we will conveniently couple with TradFi when the S&P pulls back potentially. To me, this isn't like short territory. This is be careful if you're long territory. Something I never want to do is short anything near all-time highs, short anything in price discovery. I'll talk about Apple at the very end. Same concept. That's just not where my head's at most of the time. But this is definitely in be careful territory. DXY on the 2-day. Again, this is relative to the rest of the world and what the rest of the world is doing as far as hiking, easing. Are we hiking? Are we easing? Are we holding? Right now, DXY is just flat. If the DXY is strong like it was in 2022, we are more bearish on the crypto side of things. And you can see even in 2021, we set ourselves up here for a basically year-long inverted head and shoulders cloud breakout on the weekly, and then it just went absolutely parabolic, right? Now, I really hope we aren't doing that again, but if you ask the dollar milkshake people, there's no place for stronger opinions than the macro people. To me, the macro people are almost always extremely sure of, moon or death or doom or whatever else. And a lot of the macro people are convinced DXY is going higher. To me, this is a 50-50 because on the chart, it looks like it wants to, triple bottom. It looks like maybe descending triangle. I don't know. I don't know. It's too early here. But if we're easing, which isn't going to happen anytime soon, and the Eurozone is hiking because, inflation is out of control, then that's going to bring Dixie down. That's something to watch weeks from now. But anyway, this still to me is neutral, which is fine for crypto because as long as this isn't bullish, we're okay. If it's bearish, we have extra tailwinds. If it's neutral, we have a light breeze. And if it's rip your face off bullish, then look out below on the crypto side of things. Gold, really the only interesting thing for me here on gold is if gold actually breaks an all-time high, which I think it will, and what the Bitcoin reaction will be. Again, you've got some macro people saying Bitcoin's only done well because gold has stalled out in 2020, 2021, right? So if gold starts to break all-time highs and Bitcoin is still higher beta, they just lose that argument immediately. If gold moves to 2250 and Bitcoin's at 60K, right? Who cares about gold? Sorry. So, that's really the only interesting thing for me to watch. On gold, it's still ranging. It's still likely to eventually break all-time highs. But from a technical perspective, nothing too exciting going on there. This is NASDAQ, which, again, you should really look at S&P, NASDAQ, gold, oil. Just have that on your list of stuff, because all of that, DXY, affects the crypto side of things, for sure. NASDAQ, like I said, its best year effectively on record since 1999, and starting to get a little long in the tooth up there. We got a TKC clamp here, and it's looking like a pullback, even based on momentum, is looking more and more likely at this point. So it's definitely a be careful if you're long territory. Oil has just been a very interesting chart for the past maybe year and a half. Just kind of crazy volatility on the daily. You know, it's still below the cloud. So there's tons and tons of people, right, who are extremely bullish oil. I get it. You know, you can tell me 10 arguments, they're almost all bullish for oil. And yet we're still cutting on OPEC, and yet we're still at 70. So I don't know what to say. You know, again, there's plenty of oil. It's out there. If we want it, people will buy it. And oil gets bullish when there isn't enough oil and people need it. So on technicals, it's still neutral at best, bearish at worst. And, you know, any geopolitical event could obviously moon this thing, but it is not in a spot from a technical perspective where to expect bullish continuation or anything like that here, which is good on the you know, risk side of the house. Looking at MSTR real quick, much like coin, it has some sort of, or had some sort of bullish reversal pattern, whether that be ascending triangle, inverted head and shoulders, whatever, it doesn't matter at this point. It's above the daily cloud. I certainly think it's headed for somewhere around 450, 500 in the near term. And it feels to me like the legacy crowd is trading these crypto analogs, MSTR, coin, GBTC, BitO, right? Anything that's not native crypto is doing really well, especially today. it's up, you know, 9%, like I said. And then there's coin, which is up 12% today. Continues to look extremely bullish. This is the 2-day chart. Any news event could absolutely cripple this thing. Any negative news event. It is extremely sensitive to headlines. But on a technical basis, it looks phenomenal. So I do like somewhere in the 120 region on that one. And lastly, just Apple, I'll mention. Yes, it has a small TKC clamp. Yes, it's in price discovery. Yes, it doesn't quite have a bear div. You know, so this isn't really something I'd be worried about if I was already long. I'm never going to touch this if I'm not already in this trade. You know, the time to touch this is when the cloud breakouts happen, right? So we are far gone from that. It's still bullish, remains bullish, and doesn't even have a div at this point. So I wouldn't expect a 2x from here, but it looks pretty okay even at these prices. So that's all I have for this one. I know this video was a little long. There was a ton to talk about on the macro side of things. Like, dislike, comment, share, subscribe. Let me know what you're looking at on macro that you'd like me to talk more about or look at more, and happy trading.